Hey, if you're looking to create a set of financial projections for a contract-based business, so where you have multiple different contracts and different timing and different amounts, and it's kind of hard to figure out what does cash flow look like, or what should a set of projections look like for maybe the next year or even longer periods than that based on the contracts that you have in place or even pending contracts. This template is going to be built for you. I spent 15 years as an SBA lender, and over that time, we made over 1,500 SBA loans to small businesses. And one of the most challenging types of clients to work with was these contract-based clients. So this could be like a construction business that has a long contract, or even like professional services, like an IT business that has long-term contracts with customers. It was always difficult to understand what the future was going to look like for these clients because they had all these different contracts with different terms and timing, and putting that all into a model was really complex. And so we built a template here built specifically for this type of business. And I'm going to walk you through how to fill this template out, how it works really step by step, and then really ultimately show you how to make it useful for presenting to potential investors or lenders. That's kind of the purpose of this model. So before I dive into the details of the template itself, just a couple of things. One, if you stick around to the very end of the video, we're going to give you access to a discount code, a coupon code as our thank you for sticking around to the very end. And also, if you want to go ahead and grab this template, you'll be able to go into the description of the video below, and there'll be a link to the template that you can grab and follow along. Okay, with that out of the way, let's go ahead and dive into how this template works. All right, so here I am starting with the end of the process here. So at the end of filling out all of our assumptions, we're going to see this nice at a glance tab here with a profit and loss at a glance, some high level summary data, some graphs and charts that you could throw into a business plan or a pitch deck. You're also going to get a 5-year income statement, a 5-year cash flow summary, a 5-year balance sheet summary, and then an income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. But in order to produce these reports, we have a little bit of work to do. So we're going to jump back to our input assumptions tab here and walk through these different input tabs. So the first thing you need to know is that every cell that's highlighted in blue is an assumption that you can change without breaking anything in the model. So we have a company name, a start date here. If we're, let's say, the business is already operating, we've got an opening cash balance. You could put in a personal investment. If you've already invested cash, so if it's already operating, you could put month 0. If it's investment you're hoping to receive in the future, you'd want to put a month 1 or a month in the future. On the accounts payable side, this is just assuming that we're going to pay 80% of our bills in the month that we incur the expense and 20% on a 1-month delay. So this could be things like a credit card. So maybe you put some of your software expense or your insurance or some operating expenses on a credit card, and you incur the expense when you charge the card, but you don't have to pay the card off for 30 days, for example. So we usually use that kind of 80-20 rule there for the 80% paid this month, 20% paid next month. Fixed assets. This is where you could put in equipment, if you have vehicles, if you have a building. In this case, we thought, maybe you have a trademark. So you could put in different types of fixed assets. You could also, if you had a building, for example, you could add a building here in the categories. And then from the drop down here, you could just select building. Okay. We can also add in an SBA loan or other debt. So for example, we're going to have an SBA loan of $100,000 that we're going to get here in month 1 of the model, interest rate at 10% over a 10-year term. Okay, so now we're going to look at our input revenue tab. So this is the bulk of the complexity of this model, but we've tried to kind of simplify it as best we can, with also giving you quite a bit of flexibility to enter in your different contract details. So the way this works is you'll be able to enter in individual contracts. So we've got contract 1 here. We can set the start date and the end date. Now, it's okay if the start date is actually in the past. So remember, we're starting the projections January 1st, 2025 here in this example, but we're saying this contract actually started prior to the start of the projections. So the main thing you're going to see then is that, that portion of the contract that's in the past just isn't going to show up in the projected financial statements because we're really starting January 2025 and going forward. So we can set the end month date of the contract. And then this column here is in gray because it is a informational column only. You don't need, this isn't going to have any impact on the actual projections, but if you want to kind of identify or you want to put the total contract amount in here, you can. So this first one's a great example. So the total contract amount was $3 million, right? But some of that happened before the projections even started. So, right, that happened in February 2023 through October 2027. So what we're going to notice is that really only what's in this section here is the revenue that's actually going to be related or show up in the projected income statement and cash flow, right? So there is, in this example, in this very first example, there is likely some revenue that happened prior to the projections even starting. So this, again, is only for your information. You can put a number in here, but it's not going to change anything in the model. The one other thing you'll notice here is that sometimes one of these numbers will turn red. And the reason for that, and it's noted down here, this means that the contract amount will be displayed in red if the sum of the annual amounts entered to the right exceed the total contract amount. So what that's pointing out to us is that over here, these four numbers that we've got entered in here for what the actual contract revenue add up to more than the total contract amount that we have listed over here. So again, the model is going to use whatever you put over here. That's what it's actually going to use to create the projections and generate, projected revenue. But we just want to point out to you that if you have put in more than 500,000 and and the total contract amount is only supposed to be 500,000, we're going to just point that out to you with that red highlight. But this is what the model is going to use. Okay. All right. So this initial setup fee or initial revenue. So sometimes maybe your customers will pay an initial setup fee or deposit with signing of the contract. That's what you could put in here. And then this allows you to select a payment period for the contract. So is it going to be paid annually? Is it going to be paid quarterly or monthly? So those are the three options you can select from. And then you can put in what you expect to generate in revenue each year for each contract. Now you'll notice that these sections get blacked out here. And the reason for that is because over here we've said the end of month of this contract is October 2027. So the contract's ending in 2027. So we have 2028 and beyond just blacked out, right? Now, the other thing to note here is this contract ends in October 2027. We've put 600,000 of revenue in 2027. So what's going to end up happening is all of that revenue is going to hit before the end date. So if we were to say this was monthly, for example, that means that 600,000 in 2027 is going to be spread out monthly over the first 10 months of the year, because we have to get that in before the contract end date of October. All right. So keep that in mind. The other thing I want to point out, if we look down here, we'll see a calculation for invoiced amount for annual pay contracts, quarterly pay contracts, and monthly pay contracts. So what we'll notice, if it's an annual pay contract, so this one we'll look at first. If it's an annual pay contract, then that annual payment is going to be invoiced on the month that the contract started each year. So if the contract started in February, every February, we're going to invoice for that amount. So if I, just to show you as an example, if I were to change this date to March, what we notice is that contract amount gets shifted over, the invoiced amount is shifted over now to March. Okay, some other things to point out here. You've got the ability to enter in costs related to the contract. So let's say you have some customer acquisition costs, some setup costs. You might have annual direct labor on the contract. So let's say this is a IT services contract, and you know you're going to spend. It's $1 million contract, but you're going to spend $75,000 worth of labor every year to accommodate the contract, right? So that's what you want to put in here, what your annual direct labor costs just to service the contract will be. And then if there's any material costs associated with the contract, you can put that in here as well. You can also put in other costs as a percentage of revenue. So if there's this could be like hosting costs, or maybe you have to get some sort of insurance specifically for the contract, and that costs a percentage of revenue. So there's two boxes here to put in other costs as a percentage of revenue here. And then you can have other costs that are fixed costs. So if it doesn't really fall into customer acquisition setup, it doesn't fall into labor or material costs, and it's not a percentage of revenue, you just want to say, okay, we've got this other fixed cost amount on a per year basis. You can put those items in here. And then finally, you can set an annual growth rate in these costs. So we can say, all right, the labor cost is going to start at $8,000 a year, but it's going to grow at 2% a year because we're going to have to continue to pay those staff members more, okay? So you can set that. You could actually set a negative growth rate as well. So that is really it on setting up all the details of the contract. Now, the rest of this is really just calculating the revenue and the cash flows of the business. Now, there's an important thing in these annual and quarterly contracts that we need to point out, and that is deferred revenue. So if you have annual pay contracts, you invoice the customer at the beginning of the year, they pay for the whole year up front. You have not earned all of that revenue yet. You earn the revenue over the course of the year, but you received all the cash up front. So you receive the cash, but then you earn out that revenue over the course of the year. So the difference between what you received and what you have earned so far is deferred revenue. So let's just make it simple. If you had a $12,000 contract for 1 year, in the first month, you've earned $1,000 of the $12,000, right? 1/12 of the year. So you'd have $11,000 sitting in deferred revenue, or unearned. You haven't earned that yet. And so that's what we are calculating here, is this deferred revenue balance. So based on all the contracts that you have going on right now, what is the amount of contract revenue that you've collected, but you have not earned yet? Now you could also enter in an opening deferred revenue amount. So if you're already operating and you have an amount of deferred revenue already just to start with on the balance sheet, you can enter that here. You can also enter a invoice to payment delay in months. So you invoice this month, how long is it going to take your customers to pay? So you can set how many months that's going to be. And you can also set an accounts receivable starting balance. So if you have, when you're starting the projection, you already have, $100,000 in accounts receivable, you could enter that in here. So for example, if I just put in, and basically that 100,000 is going to it's going to be an amount that just kind of carries throughout the model. So I would, I think what you really want to put in there probably is just like, if you have a general amount of accounts receivable that you typically are going to have on the balance sheet, you could put that in there. And then we're going to calculate your accounts receivable based on the contracts going forward automatically. Okay, so then here's kind of all the expenses from up above here. We've got that all calculated down here. And then the last little section here on the expense side is we have the ability to put in like hosting costs, for example, where you have a start month and an end month. Let's say you have a base monthly amount for hosting, and then you can add a per customer per month amount. So maybe each contract that you bring on, you're going to have, if it's a software business, you're going to have additional hosting costs, for example. Now, the last thing on this tab here is just a section to put in other kinds of revenue. So if you have revenue that doesn't really fit into the contract section up here, but you just want to take some revenue and put it in kind of monthly and apply a growth rate, that's what we have the ability to do here. So you can just manually put in some revenue numbers, apply a growth rate, and you're off to the races there. All right, we are actually almost done because that is the most complicated part of this whole process. Now we're on to the easier stuff. So our operating expenses. So these would be expenses that aren't specifically tied to a contract. Things like consultants, maybe platform development. We've got remote office expense. We've got a marketing firm. So we have the ability to set expenses as either a fixed dollar amount, so I mean the same dollar amount each month, percentage of revenue, or per employee expense. So per employee, a good example of a per employee expense could be that remote office. Like if you give a remote office stipend to your employee each month, that's what you could have there. And then percentage of revenue. So what we did here is we said, okay, let's assume, as we grow in year 2 through 5 here, we are going to set some additional expenses. So other general and admin, development, sales and marketing. We're going to set those as a percentage of revenue. So I've got that entered in as 0.05, meaning 5%. So that's how you'd enter in 5% of revenue for general and admin, for R&D, for sales and marketing. And that will just scale as your revenue grows, or as revenue goes down. We're also trying to scale and kind of keep our operating expenses in line. So it'll line up as a percentage of revenue. And then the very last input tab here is our salaries tab. So here is, we've had the ability to put in direct labor related to individual contracts. So people that you're specifically hiring just to fulfill a contract, that would happen on the contract page. But if you have salaried positions that you're going to have regardless of if you had 1 contract or 10, here's where you'd want to put those salaried positions in. So you have, the job title, the category, the annual salary, the employer taxes. We usually put the benefits in as 10% of the annual salary. So that's just an equation there, but you can of course change that. You can set what month they're starting. So let's say we start with the CEO and CTO in month 1. By month 13, we're going to hire a developer and a marketing lead. And then by month 15, we're going to actually hire 2 assistants. So you can see here, this number of particular employee, you're able to set the number of that position that you're going to be hiring. And then you can set the annual raise percentage. So that's for your kind of fixed salary positions. Now we also have the ability to add what we call a scaling staff team. So if you say, okay, I don't know exactly the timing of when I would want to hire, additional marketing staff or additional engineers, but you know that as revenue grows, you're going to need to hire more. Well, what you can do is put a number in here. So it says model adds each row below for every 500,000 in monthly revenue. So as you hit 500,000 monthly revenue, the model's going to, every time, so you hit 500,000, then $1 million in monthly revenue. And you can set this number to whatever you want. So it could be as you hit 10,000 monthly revenue or 100,000 monthly revenue, you can add additional scaling staff. So this could be customer support staff, it could be marketing staff, it could be installation technicians, whatever that might be that needs to scale as your revenue scales. You can set their annual salary again. Now you could also say, okay, I don't want the scaling staff team to even start until month 15. So after month 15, and then for every time we hit 500,000, an incremental 500,000 monthly revenue, then we bring on these additional staff members. Okay, that is it. But what you'll notice is, we can see here in this like cash generated from operating activities, because we have that annual contract, so you get these big jumps in cash. And so, cash flow for this type of business is really hard to predict. Again, that's kind of where we started at the very beginning here, saying cash flow can be really tough to predict, which makes this template be, I think, incredibly useful as you're trying to layer in your different contracts and see when am I in danger of running out of cash. Now, specifically, I would recommend that you go take a look at the cash flow statement broken down by month and just take a look. I'd always look at this cash at the beginning of the period. And what you want to do is just make sure that that never goes below zero. If it does, then it might be that you have, too much time between when you're receiving payment on that next contract. That might be the way that you identify, hey, here's my gap. Here's what I'm going to need to, get a loan or raise some additional investment to help cover this gap. Or maybe I need to hold off on hiring that new person or buying that piece of equipment. Maybe I can't afford that yet because I've got this gap here. So that's really the purpose of this. And I hope that you'll be able to utilize this well and kind of visualize what cash flow is going to look like out into the future. So, all right, with that said, as a thank you for sticking around to the very end, I have put a link in the description of the video below to a form that you can fill out. If you fill out that form, we're going to email you our most up-to-date discount code. You'll be able to take that discount and utilize that on this template as our thank you to you. So if you have any questions at all, please reach out to us at support@projectionhub.com. We know this is a relatively complex template. And so, if you watch this and say, I just want someone to fill this out for me. I've got a list of contracts and details of contracts. I could give you those, but I don't know how to fill this out, or I don't want to fill it out. Reach out to us. We have a template fill out service. We can help you with that and really just handle the spreadsheet piece of this for you and just make that a little bit easier so that you can get back to fulfilling those contracts. So, all right, with that being said, again, reach out to us, support@projectionhub.com. If you found this video to be helpful, we'd love it if you like and subscribe to our channel. Thanks.